Good morning, everyone. We are into the 19th session of CA Speakers Forum, which was launched on January 1st, 2026. We express our deep gratitude to you for taking out time and joining us today on Saturday morning at 11 a.m. UAE time for this session on taxation. My deep gratitude to our speaker, CA Bhargava Srinivas, who is here today with us to take this 1 hour long session.
Thank you. Thank you.
I have been a part of the UAE ecosystem for close to 19 years, and since taxation started evolving significantly in the year 2017, you can say, like we can say, we are into the 10th year of evolving taxation environment, and the journey of that evolving taxation environment in UAE continues. And that demands that we pay attention to what's happening. We learn from the experts, and we are able to disseminate that knowledge, whether it is our work or sharing with our colleagues or friends. So therefore, considering the importance, considering that it needs our attention, considering that there are professionals who are encouraged to join for this session. We are back with this taxation session. Last week we were with IFRS, and today the person who is speaking today, he is coming on this forum for the second time, CA Bhargava Srinivas, who is on the spotlight now along with me. So Bhargava is a young professional, I would say, and he's a qualified chartered accountant, has more than 8 years of experience, and professional post qualification experience. I know him as a tax expert, and his areas of taxation practice are very vast, where I would say transfer pricing, international taxation being his core areas of work. And he's an immediate past chair of Mysuru branch of India. He divides his time between India and UAE. Currently, I understand he is in UAE. Last time when he joined, he was in India. I'm not sure if Bhargava has changed his place. He can share where he is today. So, but we have an audience joining from all over the world. And thank you for you. Thank you to all of you who are here. And I request all of you to please show your love and give a warm welcome to Bhargava with the emojis you can use on this Zoom meeting. Thank you to everyone. Thank you. Thank you.
Thank you.
So thank you, Bhargava, for joining us. And before I completely hand over the screen to you, what would be your opening remarks in first 30 seconds or 1 minute you can share, and then it will be all yours. Yeah.
It's a pleasure to speak to you all. My sincere gratitude to Prabhdeep ji for creating this platform. And it's a great opportunity to share. And by sharing, we always learn. Every time we share, I think the person who is learning more, I always feel is a speaker more than anybody. This is my experience.
Right.
Thank you.
Thank you. Thank you, Bhargava. We are looking forward to your session. 60 minutes you have, then we will, if required, we will extend it by 10-15 minutes for Q&A. Over to you. Thank you.
Very good morning, all of you. So had this particular topic, I think I've been had the opportunity to speak for the last 1 month in 30 days in couple of places. And I think the first proposal was by Prabhdeep ji saying this should be done. And that's when I actually prepared the presentation and I was ready for it. So I'm going to share the presentation now. And okay. Yes. Okay. So we're going to keep it very simple as possible. So the idea is to throw light on where non-residents are going to be taxed in UAE, first of all, and how is our tax border regime? How strong is it? Or UAE following a wait and watch approach, or in terms of you can say compliance level, where do we stand? So, strictly speaking, we are 1 year down with compliance, and we are almost in the second year, next 90 days away from the major compliance with respect to corporate tax. So, today I'm going to speak to you on these particular topics covered today. These are the topics I'm going to talk to you specifically. Can you guys?
Yeah, Bhargava, I've muted all. Can you please unmute yourself?
Thank you, Prabhdeep. So this is the broad scope of the topics covered today. The idea is to throw light on non-resident taxation, which is other than Pillar Two and Pillar Two, where we will see some examples as to where does this really fall, where is it taking us, and how far are we in implementation of Pillar Two. That's the idea of what we're talking today. Now, so going to the next slide. Okay. Now, first of all, I'm sure all of us know what's a non-resident here. We have two kinds of non-resident as classified under the UAE tax law. That is our federal decree law of 47 of 2022, along with its cabinet decisions, ministerial decisions. So it classifies natural person and juridical person. So if I'm trying to jump into the space where only speaking on where a non-resident will get taxed for earning income in UAE. Okay. Now, the first place, if the first of all, let's have a small recap of things. First is a resident will always be taxed in UAE, correct? So a non-resident will not be taxed in UAE. Simple. But how in any of these cases do we have non-resident getting taxed in UAE? This is a simple question we are trying to answer. The first issue here is we'll cover permanent establishment of a non-resident in the UAE, state-sourced income. Third is nexus. The nomenclatures seem a little complicated. As we go ahead, I'm sure it's going to be made as simple as possible. Typically, we'll bring it to the common man level. Okay, I want you to concentrate on this. Jumping into what permanent establishment all about. So I have quoted Article 5 of OECD Model Convention and UAE Corporate Tax Law. These are two definitions. I want you to spend 20 seconds on this. I'm going to explain what it is. Right. I'll tell you what is the difference in this. So Article 5 of the OECD Model Convention is a typical model which is given by the OECD for us to customize, for every nation to customize according to its requirements. But please note that OECD definition is an exhaustive definition and it's not an inclusive definition. It will define only these set of things will become a P anywhere for a non-resident. But our UAE permanent establishment is, I think, lesser impact than the many of the PEs across the world, PE definitions across the world. So what does our typical PE actually capture? Our UAE PE captures one is fixed place of business of a non-resident. Let's say we have an entity in KSA and tries, and a KSA entity is a non-resident to UAE for UAE purposes. How does it, how does it, how does KSA entity be treated as a permanent establishment in UAE for which purpose? So let's say it has an office here, it's a branch here, or it has a liaison agent here, or an agent. We'll discuss whether it's dependent, independent, will come later. I'm trying to give you a small hint as to how a fixed place of I'm talking about fixed place of business here, and how are we going to classify what is a fixed place of business? Okay. The second thing is somebody who's habitually exercising a contracts, like our example, the KSA entity, try who is a non-resident for UAE purposes. So let's say there is a person who is sitting, who's executing on the instructions of the KSA entity. Maybe he's running around doing sales, arranging for services, arranging for goods. We don't know about it. These are the kind of things which will become create a PE anyway. And what is other nexus? Any other nexus? We will park nexus for some period of time, and I'll typically come back because I have some peculiar examples to give you, so that I'm sure you'll be able to understand what nexus in a larger context. Okay. Now, these are the specific exclusions as to what is not a PE. So, UAE being a mature platform for logistics supply, logistic exchange, and our well-developed ports. So, these are the things which is this is straightforward from the law. There is nothing to much really worry about. If you're trying to store goods for the purpose of further export, or maintaining stock for purpose of further export, I think this is not a permanent establishment. This is where, and this is typically not deemed as having a permanent establishment. This is what the exclusions talk about. Okay. Now, I would want to take you to a little bit of what is a fixed place, what is a agent, what is the agent typically. Now, let us move to. Okay, I've written a lot of examples. I'll share this PowerPoint presentation with all of you. To keep it simple, okay, I want you to read this Article 66 here, first of all. So, to the extent the terms of an international agreement that is enforced in the state are inconsistent with the provisions of decree law, the terms of the international agreement shall prevail. It means DTAA between, say, US, UAE, and KSA is superior when it comes to the transaction, which is a cross-border transaction. So let's say, for example, there is a branch in KSA is the main headquarters for a multinational, and it has got a branch, or it has got an office in UAE. Now, for income arising from UAE, what is the kind of decisive factor? Whether what is taxable? What is the rate of tax? What is the nature of classification? Is it the domestic UAE law, or it's a DTAA? The question is whether we have to choose between it is domestic the domestic UAE corporate tax law, or the DTAA. The superiority is always for the DTAA. It is clarified by article. It is clarified by Article 36 and Article 66. Okay. Now, I want you to note. I want to give you a few examples for you to make sure you understand. P is one of the most important concepts here. So I want you to understand this quite well. So 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 let's start with how we have a concept here, and how fixed place. I've taken a real world example. I've written a few examples here. Tech Consult UK secures a long term engineering contract in Dubai to execute. It's a UK based company. To execute the project, they rent an office in Business Bay and station 3 engineers for 10 months. That means a UK company has got an engineering contract in Dubai, somewhere in Jebel Ali, somewhere, and they rent an office for 10 months here, and they have the core engineering team sitting here. So the question is, does UK Tech Consult, a UK company, since it's a non-resident, create a permanent establishment in UAE? The question is that. So since they have an office, they have an office on rent. Even a rental office also creates a P, and they have stationed their core engineering team here. So we have the substance in place, they have the office in place. So because the office is permanently accessible to Tech Consult UK and they conduct core income generating activity, it constitutes a fixed place of business for you. So this is the clarity on what we're talking with respect with typically with respect to permanent establishment. Now let's go to the agency concept. So there's a French retailer, very. I've just morphed the names a little bit. Okay, Paris Fashion appoints a local agent based in Abu Dhabi, basically Mr. Ali, to promote its goods. Ali is given an opportunity to negotiate and regularly conclude sales contracts with regional department stores on behalf of French parent without parent making any material modifications to the deals. Because Mr. Ali is habitually concluding contracts in the name of a non-resident, Paris Fashion has created a dependent agent in UAE. This is a second variety of permanent establishment concept, which makes the non-resident have a permanent establishment in the state, which typically means non-resident extends his arm inside a foreign jurisdiction and is writing contracts, is creating business opportunities, is exploring business opportunities and making generating income or loss, whatever at the end of the day. But there is an extension of the non-resident's arm outside its resident jurisdiction. So I have written also a contrast. If Mr. Ali were an independent broker, it would not trigger a P. Very important. So we are trying to highlight the difference between if he's an independent who is, let's say Mr. Ali, who's an independent, if he was an independent broker and distributor, I'm sure he would be a broker for multiple fashion agencies. So in that case, he would not be called as a agent. He would not fall under the agent concept, that is clause 2 of P, where the Paris fashion would not have been in the UAE, since the local agent is appointed by, if you read the question here, and he's an typically exclusive for Paris fashion. And his main work, his core income generating activity is all about working for Paris fashion, enhancing the visibility brand in UAE. That's when a dependent agency gets created in UAE. These are two very important examples. Now, I have not written any example for Nexus. Let me explain what Nexus for you all. Okay, Nexus is a actually very interesting concept, typically. So let me give you an example. Let's say there is a new AI company. Please, all of you, please concentrate on this example. Nexus is somewhere, it has to be defined with an example. Then only I can give you a proper explanation. So let's say there's a new AI company which is in the US. Let's say we call it, let's say, it's a new AI company. Okay. Now this AI company is in US. It does not have offices anywhere in the world. It does not. It has not. It has not even got a agent to sign up contracts. Am I clear? I'll repeat my question. A new AI company in the US. Its server is located in the US, and it has no fixed place of. It has got no fixed place, no agent, and in UAE, for the purpose of UAE, it has got 500,000 UAE citizens, residents signing up and subscribing to this AI subscription, new AI subscription. Mark my words, it has not got a fixed place of business. It does not have an agent who will sell its AI subscriptions. No. But tell me, how do we actually tax this person, because there's an income which is arising in UAE. So therefore, how do we tax this person? So can you please respond in chat? I think it's very important for me to understand what you're thinking. So how do you tax this AI company if 500,000 subscriptions are going from UAE? In what clause can we tax them? No, let me repeat my question. If this 500 subscriptions is, let's say, generating, let's say, 50 million, So this is typically income arising from UAE jurisdiction. My question is, how will this 500,000, 550 million revenue generated in UAE, how can this be taxed in UAE is the question. Is there a clause? Where can we classify? Since it is the income of a non-resident. Okay, non-resident is the new AI company. It does not have a fixed place of business. It does not have an office. It does not have an agent. How do you tax this income? Let's not talk about pillar one and all that. I mean, let's restrict our correct. I think we're in the right answers. It should not get taxed if the company has no specific sales channel UAE. But the question is the since I am telling you that it is an income of a non-resident. Non-resident, even though withholding tax is zero, someone is giving me a right answer. Withholding tax is zero. How do I? This is an income of a non-resident generated in UAE. It cannot be a it is an income, but we do not have the proper provisions to tax it. This is the question. So there are similar provisions in across the world. We have something called as in India, we have something called as significant economic presence. So in Malaysia, they use what is called as equalization levy. So these are the kind of things. And for example, if it was Saudi for that matter, they would have withholding tax concepts where they cut some portion of the money before it goes up. But in case of UAE, where the withholding tax is still at zero rate, how do you think we have to tax it? Now let's understand the fact that we have a nexus definition. However, nexus definition says if there's a nexus created in UAE, what is a nexus? Nexus basically, if the nexus has to be created, what we are talking about is there is a nexus for creating that income in UAE and hence has to be taxed. But the nexus, typically nexus definition, I'll go to the nexus definition. You'll understand it quite well once I go to the nexus definition. Ha. So please read. If I have to complete this concept, you have to really concentrate on this. It's a little complicated. I want you to pay attention to it. The taxable income that is attributable to the nexus of a non-resident person state as determined in the decision issued by the cabinet decision. Which means, see, I have created the law has created a space where if there is a situation where non-resident is not being taxed because of the various type of technological innovations or the circumstances which create in such a way that it's impossible to tax a non-resident, I have created a residual clause where I can notify, I can through a notification, through a cabinet decision, I can say this becomes taxable. Am I clear, guys? Please pay attention. So I'm just telling you a new AI company, just to repeat the example and where does it exactly get taxed? I want you to concentrate. I'm repeating the example for sake of all of you. So AI, new AI company is established in the US. They're doing very well. They're very famous. They have a 500,000 subscriptions in by residents in UAE. So they collect a 50 million revenue, 50 million dirham revenue for say year 2026. Since they are a non-resident, they're not taxable. They don't have a permanent establishment. For example, they don't have a fixed place of business because server is located. They don't have an office. They don't have a liaison office. They don't have anything. They don't even have a website. Their digital website also in UAE. .ae is also not there. Let's say what about an agent? For example, let's say they hired some 10 agents, typically people who've been paid salary from US. That is also not there. They do the complete digital marketing outside the country. So there's nothing where you can tell them either it is they have got a PE or not. Now the only place where I can actually tax them inside a PE definition is the nexus definition. Now, what is the nexus definition created by UAE typically is that if the non-residents, even though income is clearly arising in the country, and if I'm not able to tax by existing clear set of principles, that is fixed place of business or habitually or agent principle, I create a nexus definition. Now, what is in our nexus definition? I'm sure nexus definition has got a cabinet decision which says income arising out of a immovable property. Income arising out of an immovable property is when it is going to be taxed. Now let's please concentrate. Please concentrate. Now I have taken this example between UAE and US. Okay, UAE and US do not have a DTAA till date. Okay. Now, what if this was typically sitting in KSA? The AI company was sitting in KSA, since UAE and KSA have a DTAA. Am I clear? Am I clear, guys? I'm just changing the example a little bit. Am I clear? Please respond, all of you. Am I clear? Yes. So I'm changing this example a little bit. I'm changing example. I'm assuming that this AI company is in KSA, where we have a. I'll repeat. I'll repeat for somebody who's not understanding. I'll repeat it. This AI company is assuming, for the sake of this example, is in KSA, where we have a full-fledged operational DTAA between UAE and KSA. Now, can I, since we have a DTAA, can AI company sitting in KSA tax this portion of say 50 million revenue, which is income of a non-resident of a KSA entity? Now, the point is, I'll tell you how this nexus definition of P. So in UAE domestic law, domestic corporate law, we have a nexus definition inserted inside the PE definition. That means our PE, our UAE PE definition typically has three clauses, three typical, you can say, tax nets or base creation, where it talks about fixed place, talks about agent, talks about nexus. But when I go back to my DTAA, which is superior between UAE and KSA, the PE definition in the DTAA has to capture this nexus. Am I clear? If the PE, if the PE definition of the DTAA between UAE and KSA does not capture nexus, I think the non-resident can take a benefit of DTAA and typically be not taxed for this 15 million. Are you understanding? Even though your domestic law is strong enough and withholding tax is 0%, your DTAA says that the definition of PE does not include nexus definition. I cannot capture this digital income. Am I clear? So since if the AI company was from KSA for sake of brevity, and my PE definition in UAE was expanded to the nexus definition in UAE was expanded. Domestic law was expanded by a cabinet decision to include digital income. However, if my KSA and UAE DTAA does not define this nexus inside the PE definition inside the DTAA, the non-resident can still avail the benefit. Am I clear, guys? Is my example clear? Can you all please respond? Exactly. The question is, how will UAE tax a non-resident? Because UAE cannot tax this non-resident. That's what I'm trying to tell you. UAE cannot tax this non-resident. That's the difficulty we are facing here. See, first of all, our withholding tax is zero. I cannot withhold anything while payments are made to the, let's say, the AI company sitting in KSA. Since the AI company is sitting in KSA and my withholding tax is zero, no, not even a single dirham is being cut. Second, my nexus definition, local domestic law, PE definition has got digital income has an expansion through a cabinet decision. But however, my PE definition in DTAA is not amended. Typically, it's a free income, non-taxed income for the KSA entity. Am I clear? This is how the law is operating currently. This is the beauty of the law which has been operating currently. Anybody else? Can we move on to the next concept? This is how law typically is operating. Our nexus definition, our withholding tax is very liberal today. The UAE is typically running the wait and watch approach. It is not clasping on anything right now, but trust me, it is going to come. I'll tell you a similar example in India. In India, I mean, all of us are Indian chartered, assuming we are Indian chartered accountants. So we have Section 9 of income tax. But does that mean non-residents need to come forward by themselves and pay tax? That's generosity. So there's a Dhavalji sir asking, does that mean non-residents have to come forward? Yeah, that's generosity. Okay, another very good question we are getting from one of the participants. How does it work with a non-DTAA countries? Simple. So non-DTAA countries, what happens? It's actually more beautiful in case of non-DTAA. Let's take an example. If we did not have a DTAA between, let's say, go back to our example of US and UAE, where they don't have a DTAA till date. Now, UAE typically, if it expands the nexus definition, Mr. Ashok, please listen to this. If the nexus definition is expanded and cabinet decision says digital income is taxable, we can just tax the digital income and create a small, taxable statement in income statement in UAE for this purpose. And 9% taxes are paid. Now, what happens in UAE since there is no DTAA in US? The non-resident has got a provision in IRS, that is US federal tax code, where he can take a unilateral benefit of the tax paid. Let's stop it here, but there's further things. But this is how a non-DDAA country will work, how the income really works. Are we clear? This is very important for you to understand the effect of incomes between DTAA, between not having DTAA, having the nexus definition. Yes, fantastic. So I'm just moving. I have written few examples for all of us to make sure we understand PE definitions, because permanent establishment is one definition which I think we have to understand in a little detail in the context of UAE. So that is the reason I have written this in a little detail. I want you to pay some attention to this, and I think I'm sure all of you are participating quite well. So I'm sure it'll be easier. Okay. Okay, this is done. This is let's skip this. Okay. Okay, I have deliberately taken our love triangle of UAE, India, KSA, where they're live running TTAAs between all the three countries, and that being the case, I've just taken a few examples as to where we can fit in these three things to understand how the DTAAs work, because DTAA is the ultimate decider for your cross-border tax regimes. Okay, now I have written here that it is a construction PE. Okay, so okay, there's a project running between India and UAE. For example, I'll give you a small example here. UAE has a large, our new Creek Tower project, which is going to come up shortly by Imar. I'm sure all of us know that. So we have a construction company sitting in India who has got the project execution, has got enough manpower capacity to arrange, 10,000, 20,000 manpower at a very short period of time. And we know the execution power of UAE and the speed of the execution. So that being the case, so Indian company sets up its labor camp here for construction of our Creek Tower for more than 90 days. Now the question is whether the Indian fellow creates a non-resident in UAE. The answer is yes, because we fall under clause one, typically, which is fixed place of business. Now DTAA gives a small simple exemption that if it is more than 90 days. Please note, if he does not cross 90 days, it is still not called a PE in UAE. That's how it works. Service P is more same typical old service P. Let's not talk about this. I'll share the presentation for you. So that's how it is. Now, dependent agent also has got no protocols in terms of any thresholds. So this is how our typical UAE India DTAA works for you. Now let's understand one very important case law which the Supreme Court of India decided on the basis of India and UAE DTAA. So in the Hyatt International Southwest Asia case, the Supreme Court of India ruled that a foreign enterprise without a physical brick and mortar office can still trigger a fixed place of business simply by holding continuous substantial operational control over such as personal managing, branding, pricing, hotel operations. I'll tell you this case, very interesting case. We all know Hyatt, Grand Hyatt typically. So Grand Hyatt establishes hotels in Asia, especially India, Pakistan, Bangladesh, Sri Lanka. Okay, so but it holds operational control over the premises of India in India in, let's say, UAE. Now, 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 the question is through a agreement, a management via a facilitation agreement will typically define whether what is the kind of control the UAE entity will exercise over its Indian subsidiaries and Indian brand of hotels. Okay. Now the question is, does UAE has PE in India? We're talking about two different things, but we're ultimately discussing our DTAA. The question is there a fixed place of P created in India for UAE purpose? Let's assume for the sake of simplicity that there is a fixed place of P concept even in India. So it is covered by Indian domestic tax law. It is covered in UAE domestic tax law. It is covered in the DTAA also. So your first check is local tax laws, second check is DTAA. Both the places it's covered. But the question is, this the Hyatt International Southwest Asia Limited, which is typically a UAE company, does it have a fixed place of business in India? Is a question. So it does not have a fixed place of India is the point, because the Indian entities are separately managed. The point is the contract, the management or trade facilitation contract, what they have has operational control over day-to-day operations. And since the resulting hotels are physically located in India, the Supreme Court decided that it is deemed to have a fixed place of business in India. I'll tell you, this typically comes from post BEPS models, where it is talking about what is called as a, okay, I'm writing here, it is called PPT. Okay. Okay. This is called principal purpose test. Do we have any doubts here? If I'm not wrong, it is a threshold of 6 months or more to consider a construction PE for UAE CT purposes. No, this is typically depends on what is written in the DTAA. It is not specific to corporate tax law. It is specific to the DTAA. Every DTAA. I'm just answering the question. One of the participants is asking me a question which says, is there a specific threshold? The point is the thresholds are defined in each DTAA. For the next DTAA, I think the threshold is 183 days for between UAE and KSA. So India and UAE have a 90-day threshold limit. Okay, I'll just get back to the principal purposes. I just don't want to lose the momentum here, because I have to logically take you forward. So principal purpose test typically means that if you're undertaking a transaction for the purpose of evading tax, then the transaction is not allowed. And if you're undertaking a transaction in normal course of business, it is typically allowed. Now, if let's say, why I'm bringing this concept here is that you have to start thinking in this in terms of this concept. Let's take an example between UAE and India DTAA. Okay, so UAE and India DTAA, the Indian company returns to India with its all labor, all immigration process over on 1890. Please answer my question, all of you. I'm asking a question. The Indian company returns after the construction project. Our Dubai Creek Tower, which is being constructed, it finishes in 87 days. Okay, it does not cross the 90-day limit. It says if it finishes off in 87 days, 89th day, it leaves the country UAE. Answer my question: is Indian company deemed to have a PE in UAE? Please answer my question. Others, please. I hope I'm not making you sleep. Okay, the answers are right, but there's a small catch here. If the purpose was to evade PE, or restructure it in such a way that you typically get excluded from the UAE PE, that's when PPT comes into play. But in the circumstances, if you can prove in the proof, the fact that the construction itself was over in 87 days or 89 days, then you will not be charged. So the burden is on the FTA here in this case. The OECD commentary is really clear on this matter. OECD commentary actually says the burden is not on the taxpayer. Burden is typically on the tax authority, to prove the fact that it was a deliberate tax structure and not a corporate structure. So this is where I want you to start thinking in terms of the principal purpose test principle, where it is important to make sure that the transaction undertaken is definitely not for the purpose of tax evasion or tax planning also, but it is purely for the commercial purpose of the transaction. Are we clear? Aren't all there's a double G is asking, aren't all intelligent purposes to plan taxes? Very good question. I think the law post 2015, especially the OECD commentary, is trying to tell us earlier tax planning and tax avoidance was two different things. I think if there is a border between tax planning and tax avoidance, that is blurring today, especially with the cross-border tax regimes, because substance over form is the thing which is now every jurisdiction is adopting. And if substance over form is not clear, is when the problems are created. So tax planning, if it is very extraordinary and very creative, it becomes tax avoidance. And let's say more than tax 50% of tax planning is becoming tax avoidance. Exactly. Yes. It is no more that. It is no more that. It is no more tax planning is tax planning is definitely going to become tax avoidance in the future as we go, and we're just waiting for a lot of decisions to come from UAE, which will make it clear, because UAE would exercise authority. Yes, substance over form. Absolutely, sir. I'll just read out. I'm sure all of you have the access to the chat. It's heartening to note that the principle of justice is taking precedence over master of English. Absolutely. So that's the idea. Let's go to the next one. We have another 40 minutes to go. No worries. So this is again UAE KSA DTA. Please note the number of days where it is mentioned more exceeding 183 days. I've written it specifically. So even service fee, they are defining very clearly 183 days, and they have typical exclusions for storage and display of goods, which is not. We're very similar to UAE, but they're defining 183 days in both the cases, which is the limit. So even if you have a fixed place of business, but it is not exceeding 183 days, you still don't create P in either of the nations, either of the contract. The word uses contracting states. So the contract is between a multinational entity or a multi-jurisdictional entity in between UAE and KSA. Each other don't exceed the stay beyond 183 days. It's still not considered as PE. Thank you. So are we clear on this? I think this is very simple. Can we move forward? Please give me your consent. Are we clear? Can we move forward? Oh, thank you, sir. Much obliged. So next, I have taken the balance of the love triangle between India, Saudi, and UAE. So the construction P talks about 182 days here and not 183. Please make note. I have deliberately written the number of days here to make sure it is very clear. So and our dependent agent is also covered. Exclusion safeguards also covered. So this is as good as same. Fixed place of business and dependent agent is covered. The time limit is only 182 days. So I'll share this presentation for all of you, but make sure you're listening to me very carefully here. Okay. So let's go to the few practical examples. Uh, so the Vanguard here is not our great Vanguard entity in the US. Please don't start thinking like that. I've just used it for the sake of keeping us all awake. I know the kind of concepts we speak on the tax side is very boring for majority of the people. Yes. So let's read this scenario. Vanguard Software Incorporation is a US incorporated SaaS company with no physical offices, servers, subsidiaries. Please note this very carefully. Please note this. Has no physical offices, servers, or subsidiaries in UAE. To capitalize on the regional market, Vanguard hires Mr. Tariq, a highly compensated senior sales director. Senior sales director. Please note, please make a note. Tariq is a UAE resident who works remotely from a villa in Dubai. He's in Arabian ranches because he's got good salary from US. Okay. Tariq is given a company laptop. Remember the company laptop and full authority to negotiate enterprise software contracts with large UAE semi-government entities. Crucially, because the price matrix is standard, Tariq, so this is also very important. Price matrix is standard. That means there's a mandate from US that this is the price matrix, do whatever you want. Tariq negotiates the terms and hits the approve on the portal. This automatically generates a binding contract without requiring signature from the US executives, even though a digital signature is typically a signature. Furthermore, Vanguard routes all Middle East regional technical support through Tariq's home. Very important, very important. Please note Tariq's home and uses his dedicated space continuously for this purpose. Please take note of this. Will So is P created in UAE is the question for all of you. If yes, where is it created? Can we have answers on this? Can we please have answers on this? Is there P created? If yes, where? Of course, in Dubai, if it is P. But how do you conclude? P is created. So typically, the Vanguard company does not have an office in UAE. Very good answer. Tariq has a permanent place of operating. Yes. Tariq's home and Tariq's laptop is typically our, I mentioned here, a company laptop is the Tariq. And it also says, we'll come to the dependent agent a little later, and also says Tariq's home, Tariq's home. If you read this, Tariq's home is used as a dedicated space for continuous purpose. Now, Tariq's home is clause 1 and Mr. Tariq is clause 2. Am I clear? Tariq's home in UAE is fixed place of business. Tariq himself becomes an agent because typically the price matrix is a standard. There's no changes, and it is fixed in the US. He's only doing a sales job. Yes, both. Yes, absolutely. Are we clear? All of you, can you please respond? All of you, can we go ahead? So I just analyzed the same thing. Okay, your answers were right. Can we read this scenario next? I've got one more example for all of you. Infra Build KSA, Saudi construction engineering firm, sends a massive infrastructure development project in Abu Dhabi. Note it's inside UAE. The timeline, the project requires heavy machinery and on-site engineers to build schedules. The work to take exactly 5 months, running from January to May, aiming to remain safely under the 6-month construction period. Remember, it is between UAE and KSA, it is 180 183 days. 183 days. Okay. So due to unexpected delays, the physical construction finishes in 5 months, but infra build specialized technicians remain on the site for another 3 months to conduct testing, calibration. So remain on the site. Remember, on the site for testing, calibration, mandatory supervisory handovers. Additionally, infra build subcontracts a portion of the work to its sister company, InfraBuild UAE, a free zone company whose employees are on site for 2 months. Do we have a P? The question is, do we have a P? Where do we have a P? If yes, where? No, there is no P. Can we have all of you answering? I think we have 28 people. If you all can answer, it'll really be helpful to understand whether you're understanding or not. Can we have all of you answering? Hope I'm not making you sleep. If any of you are sleeping, please wake up. Can we have all of you putting your answers in the chat? Yes, yes, yes. I'll explain that. I would like, I want all of you to start thinking the logical sequencing what I'm trying to think. Okay. So first of all, it's a KSA company. It's a Saudi construction company. It's a Saudi entity. It's a juridical person in Saudi. First of all, it's a non-resident on prima facie. It's not taxable in UAE. Yes. The second point is because of its activity in UAE, is it going to create a P? Is what we are trying to understand. So it's running a project site. So there's a project site which will be typically covered under clause one, which is fixed place of business for purpose of UAE. Now the thing says exactly 5 months and aiming to return at 6 months before, so at 182, 183 days. So the point is other 3 months, and the two things which I want you to note here is that its engineers stay on the site for another 3 months to conduct testing, calibration, mandatory supervisory handovers, which is typically a part of the contract. So it becomes 8 months. Additionally, infra build UAE, which is a free zone, which is a sister company. So substance over form, either you or your sister company is staying here. So it is typically a P. You cannot escape. So this is the answer I felt is right. It is directly hitting clause one, fixed place of P. P is triggered. Are we clear? Is there any doubts on this? Can you all please start responding? We are 28 of us, very small team of us. If we can respond and wake up if you're not sleeping, it really makes the session worth it. No, so let's. Is there any doubt? One of the participants. I want you to understand and take the value from the session. I don't want somebody saying you are the final expert. No, 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 no. I want you to become the expert once you have this session. Correct. The answer is correct. Even if the sister concern is not in the play, it's still the PE because it's extension of yes, yes, absolutely, absolutely, yes, yes, yes. It's a clear PS. Pure principal purpose test, part of the UAE as OECD signatories, that it is principal purpose test significantly it has got the influence. Yes, and it's floating team. It does not require its like somebody really told, it does not require its subsidiary to be considered. It is directly P. Okay, can we go to the next one? Okay, now all this now we have seen. This is purely non-pillar two. I mean something at the group level, where the total turnover is less than 750 million euros is when we were all these examples what we were seeing. I want you to consider a little bit. This is little slightly complicated, but it's a large exercise. Considering the numbers are big and the subsidiaries are big and the associates and joint ventures are big. So this is typically the pillar two. Okay, there's a question from one of the participants. Rather, considering that UAE needs a visa for working and a number plate, even off-road equipment, I also wonder how they intend to make it legal that the engineers and equipment be here legally. Sorry to go back to previous. See, all I'm saying is that even the point is the whole existence of so they the contract, the visa can be issued by the this one the customer itself, no? If the visa is issued by the customer, where is the presence? Visa, if visa is issued by the customer, it is over for the purpose of the executing the contract. So substance over form. What we're trying to analyze is the substance over form proposition, which makes sure that even though the form is not there, the India company or the UAE company which is coming inside. Or the KSA company coming inside, we are only we are only trying to understand whether the substance and form which is weighing higher. The substance should be clear, simple. Can we go to the next one? Are we clear? Yes, thank you. So pillar two globe rules. What is it? Where are we coming from? How is it? How is it? So first of all of us know for one fact the corporate tax rate in UAE is 9%. Now I have put something on the screen as 15%. You might be wondering what is this guy really talking about? So it is not the same rate, it is a difference rate. The other remaining 6% is extra corporate tax which you have to pay if you are a part of a multinational group where your group revenue is crossing 750 million euros. Typically about 3.15 billion dirhams. That's the conversion rate. So if your group revenue at a group level, let's say you are present in 10 countries, your group is present in 10 countries, all 10 countries together. If knocking off your typically I mean post IFRS income, let's say IFRS income, if you have more than 3.15 billion or converted 750 million euros, yes, then this particular pillar to globe rules become applicable. This is operated in UAE wide 142 cabinet decision 142. It is applicable from 1st January 2025. That was the first year, and 26 we're in the implementation year where we're working on this how to ascertain the statement of income. Okay, so effective rate of tax is 15%. How do we calculate is the question. Now let's go to the next one. Who for whom are this applicable? Like we discussed already, revenue threshold is 750 million, our typical 3.15 billion dirhams. So who is typically covered by geography? Very important question. Whether our free zone companies are in, which has got 0%, is it included or excluded? It captures constituent entities, permanent establishment. Please make note, joint ventures operating inside UAE, irrespective of the M&E groups, parent entities headquartered inside India or outside UAE. The question is whether joint venture, let's say I have a 50% partnership, should I consider my only 50% of revenue from JV? Yes, 50%, but while calculating the tax, it will be 100%. That's the idea. Whether my free zone entities will be overriding the 0% tax rate if I'm earning qualifying income from qualifying activity and I don't have any misnomers. Yes, it is still taxable. It has to come inside. There's no exemption for that. So, what are the exemptions? Who are those people who are not included in our DMTT? Typically, the nomenclature is used as domestic minimum top-up tax. It's 15%. That is what we're talking as 15%. Okay. So certain entities are designated as exclude entities. So we have typically pension funds, government entities, non-profit organizations, UN or UNESCO, such of entities, investment funds, real estate vehicles, and typically funds are excluded as long as their underlying investors are government entities or international profit organization or pension funds. These two, 4 and 5, if underlying entities are 1, 2, 3, it will be exempted. But in the calculation, and so there are two things. If you are an excluded organization, also you have to do the filing. You have to do the compliance. You may not have to pay additional 6% tax, but still you have to continue to do the compliance. Okay, has this is the IIR is income inclusion rules. UTPR is taxed profit rules. There's a question here. Is there a revenue limit to this besides the time limit? Revenue limit per year. Is there so typically it says there's a one of the participant double G is asking, is there a revenue limit to this besides the time limit? See, time limit is in the last in the four preceding previous years, two fiscal years, two out of the four fiscal years, if you cross the revenue, you will become applicable this year, even though this year you don't have so much revenue. Am I clear? Let's say 22, 23, 24, 25, 2022, 23, 24, 25. In those 2 years, you cross the limit, but this year, current year, you're not crossing the limit, but you have no choice but to come into the package. Okay. So this IIR and UTPR are the typical standard packages, standard calculation guidelines by OECD, but we have not implemented that. We have straightforward in UAE, we have straightforward implemented domestic top-up tax, where we'll see how the 15% is calculated. This is how it is calculated. I've kept it very simple. I have not made it complicated in terms of the nitty-gritties of it. I've just said where it is applicable and how is it calculated. Let's understand. It is typically total aggregate taxes paid by total pillar to income. That's it. That's the ETR. ETR calculation is that. So total taxes paid divided by total income into what is the percentage. So I think I'll take you to an example. This is a little, you will understand once we go to the example. Okay, guys, all of you, please read this example. I've written this example for all of you. So global revenue is 1.2 billion euros. So is the entity group applicable for DMTT? The answer is yes. UAE operations has got two entities, one in our mainland sitting in Bardubai. Second is in sitting in our Jabal Ali free zone. That's for the sake of it. So tested financial year 1 January 2025. So accounting profit of mainland entity 50 million, accounting profit of free zone entity 150 million. So total income of the UAE entity, total income of the UAE entity is 200 million. So the mainland entity pays 9%, 4.5 million. Free zone entity pays zero, nothing is paid. Total tax paid 4.5 million. See, total, please note 4.5 million is the taxes, 200 million is the total income. This is very important. Please note. Let's spend 2 minutes on this. I want you to understand. Can you spend 2 minutes on this? Okay. So let's go to the next portion. Okay. Now, how do I calculate? We all know it is 4.5 million is the taxes paid currently, and 200 million is the total income. It is only 2.25% is effective rate, but the difference is 15 minus 2.25%, which is coming to 25 million. So UAE they have to pay 25 million as the additional tax. This is how it is calculated. So there's some carve outs and carve ins for if you have a local very high value substance where you have high payroll costs, tangible asset value 40 million. So that's all computation purposes. I don't want to bore you up with all that stuff. You can always look into my presentation if you want to go. So this is how tax liability is calculated. Okay, I think let's close the session. Is there anything we can take the Q&A session?
Thank you. Thank you so much, Bhargava. You have finished very quickly. So all done, or is there anything you need to take up?
No, I am done. I'm just waiting for any questions. Open to any
Yeah.
questions.
So I request anyone to please raise your hand or unmute yourself, and we can proceed with the question.
25 from Neeraj to everyone. 25 was DMDT. Yes, 25 million was the DMDT. 25 million was a DMDT. Yes. Thank you. You made very simple and interesting. Thank you. Additional DMDT to be paid. Yes.
Anyone has any comment to make? Excellent. Thank you so much. Thank
Thank you.
you.
Yeah. Okay. Thank you. I will.
So, yeah. So
Put my PPT.
PPT, Bhargav, you can share the
Yes,
PPT
yes,
in
yes.
between. Meanwhile, Jahangir, thank you so much. Thank you, Neeraj. Thank you, Radish. Thank you, everyone. Would like to hear some more voices in this session. Anyone who would like to share anything, please come forward. Yes, Dhaval, please go ahead. Thank you.
Sarji, this is very important. In our last meeting, I had requested you that don't take a very broad topic and cover it very shortly. I- This is amazing. I mean, this is how a topic should be taken, especially for you who is having a weekly podcast on two,
Hmm.
three topics simultaneously that take a very small part and explain it in detail. It is amazing. Thank you very much. And I'm very happy to attend because I saw your post and saw Bhargava sir's name and I said, wow, this cannot be missed.
Thank you.
So
Thank you.
Yes, yes.
very, very nice. Well worth it for me. Thank you
I
so
last time I think we extended the session by almost 40 minutes.
Yes.
And so I requested also Bhargava to keep it in 1 hour because everyone cannot take 2 hours at a stretch, so 1 hour we target to finish.
And
Thank you, Dhaval.
this is very important because something as simple as how to underline totals in a financial statement, for example, where to
Hmm.
underline them, where to that also such a small topic often takes 1 hour. So
Right.
this topic also is bigger than 1 hour, but still it was very well conducted,
Yeah.
which
Thank
Bhargava sir normally always does. So it is always a pleasure attending his session.
Thank
Yes, sir.
you. Thank you. Basant, you would like to share anything?
Yes, Prabhjeet ji,
Yes.
thank you so much. I think I have missed the previous session, and
Hmm.
today I was just in front of system and I saw your message and I just joined, and I really feel as Dhaval said, for me this was the
Right.
first session, and Bhargava ji, this is indeed a pleasure to meet you and
Thank
go
you.
through your session. I now really feel ki I have missed the first session, so if and how I don't know how I can catch up
Yeah, yeah.
before he
First
comes
session
and
is
bombards the third session.
yeah. First session is there on YouTube, all on my channel with my name, CA Prabhdeep Singh Baweja. All the
Okay.
sessions are there under the live section. That time Bhargava was in India. Bhargava, you are in UAE today?
Yeah, yeah, we
Ah, okay. That time he was in India when he took the session.
correct, correct, correct.
No, that's
Yeah.
indeed a pleasure. Matlab, I joined probably 10 minutes late, but it's really insightful. Thank you. Thank
Thank
you to
you.
both of you.
Thank you,
Thank
thank
you.
you.
Thank you. Anyone else has anything to share? Today, we have a long day also. ICA Dubai chapter is conducting its celebrations. And those who are in Dubai, those who are ICI chapter member, look forward to meet you in the afternoon. Yeah,
Absolutely.
so yes. So thank you, Bhargava.
Thank
Any
you.
last comments before we sign off? You
Uh,
anything you think you
uh,
need to share?
I think the participants were very interactive. I mean, this kind of topic, as far as always, if the participants are not interactive, it is very difficult to conduct because you don't know where you're shooting. Is it shooting in the air?
Right.
So that is thanks all participants for being very interactive. It makes my job very easier, and I'll be able to understand where do you stand and where should I come back again. What am I explaining to you? And my language and your language, is it matching? That's the most important thing which I was trying to concentrate. Thank you so much. Thank you, Prabdeep ji. I think it's a great
Thank you.
platform. Really, thank you for giving
Thank
this
you.
opportunity.
Thank you. I request all to please, yeah, thank you so much. Please give a big round of applause to Bhargava. Thank you. And there's a request for IFRS and e-invoicing. It just uh, uh, caught my eye. Is so e-invoicing. We are coming back with e-invoicing. We already did 2 sessions. We are coming back with e-invoicing on 11th of July. And IFRS, last week we did it on IFRS 18. You can again go back to the channel and catch up on that. IFRS 19 and 20, and maybe some updates will be coming up soon. We were thinking of IFRS on this July 4th, but now we have moved that. We'll postpone it and we'll be doing AI, because AI is also in significant demand. We have not been able to do much, only one we have done. And though we will come up with hopefully 2 AI sessions in the month of July. Okay, so thank you for joining. Please encourage your friends. It's free to join. It will be a pleasure for us to have more audience every time we do. Only 100 on Zoom can be accommodated. Let us fill all those spots, and have a great day ahead. Take good care of yourself, everyone. Bye bye. Thank you, Bhargava.
Okay, thank you. Thank
Thank
you.
you. Thank you, sir.
Thank you.
Thank you.
Bye bye.